Ever felt like you're drowning in a sea of crypto advice? The internet is flooded with trading gurus. Your social media feed is packed with hot tips and predictions. And don't even get me started on all those crypto bros trying to slide into your DMs to steal your funds. But here's the million-dollar question. How do you know what's actually legit? If you've ever looked at a trading chart and candlesticks and thought, I've seen clearer instructions on how to build IKEA furniture, you're in the right place. Bullish engulfing, bearish Harami, spinning top. To the untrained eye, it's just a mess of lines and colors. But to a skilled trader, it's a roadmap to potential profits. Today, we're turning you from this guy into this guy. Or at least, we'll try to. No pressure though. And no, we're not just gonna Photoshop a smile on your face and call it a day. We'll learn how to transform this chaos into clear trading signals. We're not just reading charts, we're decoding the language of the markets. Every candle tells a story. Every pattern whispers a secret. Look at this Bitcoin chart. See that spike in November 2021? Traders who could read the signs saw it coming. That dip in June 2022? Yep, they were prepared for that too. That's the power of technical analysis. It's not about predicting the future, it's about understanding the present to make informed decisions about what might come next. In the volatile world of crypto, where fortunes can be made or lost in the blink of an eye, chart reading isn't just a skill, it's your secret weapon. But first, let's address the elephant in the room. Why bother with all this technical analysis? Can't you just trade based on news and gut feeling? Well, you could, if you enjoy playing Russian roulette with your investment portfolio. Charts give you the edge, the ability to make data-driven decisions in a market often driven by emotion and speculation. Technical analysis is like Google Maps for crypto. It doesn't guarantee you're always going to take the perfect route, but it sure beats driving around aimlessly trying to get lucky. We'll start with the basics, the anatomy of a candlestick. Then we'll zoom out to see how these candlesticks form patterns and how these patterns can signal potential market moves. The anatomy of a candlestick. Now, let's take a moment to understand what candlesticks are. A candlestick in trading is like a special picture that shows how the price of something changed within a few hours, days, or even months. Imagine you have a toy that costs money. In the morning, that toy might cost $5. By the end of the day, it might cost $7. A candlestick would show this change. The candlestick looks a little bit like a candle. It has a body that shows where the price started and ended. It has wicks on top and bottom that show the highest and lowest prices during the time period. Traders look at these candlesticks to understand how prices are changing and decide if they want to buy or sell. Now that we've established what candlesticks are and why chart reading is crucial, let's roll up our sleeves and get into the anatomy of a candlestick. Honestly, candlesticks are lying to you. This little rectangle holds more valuable information than most people's entire trading strategy.
Are you serious? Thank you for what? Standing there?
But their lies tell the truth about the market. These little rectangles with wicks, they're the market's emoji. Happy, sad, confused. It's all there. Green means buyers won. Red means sellers took over. Long wicks, drama. Short body, indecision. Now you might ask, what does a body and wick really represent? The body is like your Tinder bio. It's a main event, showing the range between open and close. It's a highlight reel of your personality, the part you want everyone to see. The wick is like your actual and real personality. It only comes out in extreme situations. Long body, short wick is like when you confidently slide into someone's DMs with a fine pickup line. Strong conviction, baby. Short body, long wick, this is you trying to decide what to watch on Netflix for 2 hours and falling asleep 10 minutes into a show. Indecision city, population, you. Let's move to reading the candles. Open. It's a price at the beginning of the trading period. This is like when you start your day thinking, I'm going to be productive as Spoiler alert, you probably won't be. Close. Where the price ends up when the trading period is over. Fast forward to when you're in bed, doom scrolling at 3 AM. That's your close, baby. High is the price's peak during the period. And low is the price's rock bottom during the period. It's your portfolio's way of saying, hope you like instant noodles. Now that we've learned how to read the candlesticks, let's pull up a Solana chart from TradingView. Look at this green candle here. This is when buyers are more turned on than a Twitch streamer in a hot tub. Price closed higher than it opened. This is Solana having a good hair day. Solana opens at $22.50. Solana woke up feeling pretty good about itself. High, $24.75. Someone must have complimented its price action because it's really showing off now. Low, $22.30. Brief moment of self-doubt. Probably scrolled crypto Twitter for too long. Close, $24.50. Ended the day strutting its stuff. Not quite at its peak, but hey, it's crypto. We take what we can get. Now this red candle right next to it. This is when sellers are going harder than your mum roasting your life choices at Thanksgiving dinner. Price closed lower than it opened. Big oof. That's Solana the morning after. Open, $24.50. Started the day feeling good about yesterday's gains. High, $25. Brief optimism. Probably a to the moon tweet from an influencer. Low, $21. Reality check. Someone remembered to check the general market conditions. Close, $21.50. Ended lower than it started. Time to hibernate and dream of bull markets. When you look at these candles together, you're not just seeing price changes. You're seeing the entire emotional journey of Solana traders. It's like a soap opera, but with more money and fewer evil twins, we think. Now, let's zoom out and talk about trends. Because who doesn't love a good roller coaster ride with their life savings? Remember Bitcoin's journey from 20k to 69k in 2021? That's called an uptrend that had holders updating their Lamborghini wish lists. On the flip side, remember when we saw Ethereum drop from 4.8k to $880 in 2022? Suddenly, ramen didn't taste so bad, did it? Downtrend is when your portfolio makes you wish you invested in a time machine instead. But what happens if there's neither an uptrend or a downtrend? Time to put on the McDonald's cap and work a 9 to 5. This is a sidelines period when you wish your portfolio would do something. Boring. Types of candlesticks. Here's where things get really interesting. Let's look at some of the popular candles on the chart. Doji, a candle with a small body showing indecision in the market. This is the candlestick equivalent of meh. It's like swiping on Tinder for hours and ending up with 0 matches. The market's basically saying, I don't know, might dump later. Now let's look at a hammer candle. Imagine getting rejected by your crush, but then winning the lottery the next day. That's a hammer for you. It's a bullish reversal pattern with a small body at the top and a long lower wick. Now let's look at the opposite of a hammer, the shooting star. Long upper wick, small body. It's like the market tried to reach for the stars but remembered it was afraid of heights. A bearish reversal pattern with a small body at the bottom and a long upper wick. The market just pulled a psych on all the bulls. Next up are engulfing candlesticks, when one candle's body completely engulfs the previous candle's body. It's like the big fish eating the little fish. Bullish when a green candle engulfs a red, bearish when it's the other way around. Onto some Harami candlesticks, the opposite of engulfing. A small candle's body is contained within the previous candle's body. It's like the market is giving you a bear hug or a bull hug depending on the market. Now we have the morning star, a bullish reversal pattern consisting of a large down candle, a small bodied candle, and a large up candle. It's like the classic rom-com plot, where the protagonists break up, have a moment of clarity, and then dramatically reunite. In a similar way, Evening Star is a bearish reversal pattern. This is the market's version of that friend who hypes you up to go out then bails last minute, leaving you alone at the club. Trust issues? This chart's got them too. But wait, there's more. We'll now see how these patterns fit into the bigger picture. Candlesticks solely do not make you a profitable trader. Instead, it's a combination of volume, chart patterns, and time frames. Turning up the volume. Candlesticks without volume are like tacos without salsa. Sure, it's still a taco, but where's the kick? See this bad boy? High volume, big green candle. It's like the entire crypto market collectively decided to FOMO in. Probably because Elon tweeted about his new Shiba Inu puppy or something. And this one? Big red candle, low volume. It's a chart equivalent of that one friend who's always yelling, the sky is falling, but nobody's really listening. Now you might be thinking, why should I care about volume? I'm here for the gains, not a math lesson. Volume is the strength behind a punch. A price move with high volume is Mike Tyson in his prime. A move with low volume, it's like your drunk Uncle Steve swinging at the Christmas party. See the spike here? Looks impressive, right? But check out the volume. It's lower than the effort you put into your New Year's resolutions. Now this is the good stuff. Price going up, volume increasing. Remember trends we discussed earlier? This trend has more support than your mum's Facebook posts. Trading without looking at volume is like trying to drive with your eyes closed. Sure, you might get lucky and not crash for a while, but why take that risk when you can open your eyes and see the whole picture? Timeframes. As if that wasn't enough, here's another crucial piece of the puzzle. Timeframes. You've probably heard a number of times in the crypto world. When in doubt, zoom out. That's exactly what timeframes are all about. The time frame determines the period each candle represents. To put this into perspective, let's pull up a chart on TradingView. By the way, everybody uses TradingView, so after this video, go and sign up for a free account. The 1 minute and 5 minute charts show price action in bite-sized, anxiety-inducing chunks. Perfect for tracking short-term price movements. The other weapon of choice for caffeine-powered adrenaline junkies who think sleep is for the weak. This is called scalping. On TradingView, you can find these on the toolbar. But be warned, excessive use may cause eye strain and rapid aging. Next up, the 15-minute and 30-minute charts are ideal for spotting decent entry and exit points. They're perfect for commitment phobes who like a little stability in their trading life. It's about as long as your attention span, isn't it? This is commonly known as intraday trades. The 1 hour and 4 hour charts are great for identifying midterm trends, or most commonly known as swing trading. They're the go-to for multitaskers, trying to balance real life with their imaginary profits. These trades can go up to a couple of days, to 1 or 2 weeks. Now, if you're a patient trader and you don't believe in price fluctuations, you might need a daily or a weekly chart. It's used for medium to long-term trend analysis, and favored by those who believe patience is a virtue, until it isn't. It's like watching paint dry, but potentially more profitable. And lastly, there are monthly charts. You might have heard the crypto buzzword HODL. These are the people who look at price swings the way your grandpa looks at your latest TikTok dance, with calm indifference, and maybe a hint of confusion. These charts show the bigger picture, and they're essential for identifying major trends. Congratulations, you've just leveled up your crypto candlesticks game. You're no longer the person at the party who thinks candlesticks are just for romantic dinners. Look at you now, you've gone from what's a doji to that's clearly a bullish engulfing pattern on the 4 hour chart with increasing volume. But here's the thing, candlesticks and volume indicators won't make you a profitable trader overnight. There's a whole world of technical analysis waiting for you to explore. There's support resistance, market trends, chart patterns, and sentiment analysis. A combination of all of these, along with solid risk management, should make you a profitable trader. But you might ask, where do I find all of this now? Well, you're now standing at the crossroads of potential Lamborghini and potential ramen for life. You will have to dive deeper into technical analysis, because nothing says I'm fun at parties like explaining the intricacies of a triple bottom pattern. Next, you'll have to learn about fundamental analysis, where you pretend to understand white papers and tokenomics, nodding sagely while secretly Googling, what is a blockchain? And you have to master risk management, aka how to not lose your house, car, and left kidney on a YOLO trade. Then, study market psychology, where you'll learn that the market is just as emotionally unstable as your ex. And lastly, practice, practice, practice. Use a demo account to perfect your skills. It's like paper trading, but without the risk of paper cuts. As always, do your own research. Cryptocurrency trading carries a high level of risk and may not be suitable for all investors. We are not financial advisors, but we're here to take you from zero to hero, so make sure you're subscribed. Until next time, may your candles be green and your gains be exponential.